Good morning, everyone. This is Rob McDougall here with Zhang Financial and your weekly economic update. Today is Monday, October 6, 2025. So, economic activity. We always review what happened in the prior week, and we've only got part of a week to report, unfortunately, due to the government shutdown. But we'll give you what they gave us last week and then try to tie some of these pieces together. Take a look at the info that was supposed to come out this week, and of course, in the middle of that, tell you how the markets did despite all this uncertainty. So, last week we did start off on Tuesday with a government number, and that was JOLTS job opening report. So, this number has been in focus, as have all of the labor numbers, because we'd have to say, in terms of investor focus at this point, it's really changed. The leadership has been, or the focus really had been on inflation / interest rates. Focus is still on interest rates for sure, but many investors are now really focusing on the labor numbers, as it's pretty clear labor markets have weakened. So this JOLTS job opening number reported on Tuesday. The expectation is it was to come in at 7.2 million, came in a little above that. The other thing to note here, of course, is the fact that this number, the JOLTS job opening back in 2022, hit its peak at over 12 million available jobs that were unfilled, and it's just consistently come down. So 7.2 million is the most recent JOLTS job opening number. The Wednesday number, the ADP number, employment for sure. And the great thing is it's non-government, so it doesn't have some of the issues the BLS numbers may or may not have, but also they're not shut down. So ADP reported the September job number. The expectation was an additional 50,000 new jobs. Very disappointing. Came in at a negative 32,000. So we've actually included the slide for the ADP survey, and what is really clear, no doubt about it, deceleration. Now the ADP number, it's their survey, it's only their clients, so it's a subset of what you see from the Bureau of Labor Statistic numbers. But the numbers here from ADP shows a clear trend. First 5 months of this year, we averaged, according to ADP, an additional 110,000 jobs, and now for the last 4 months, barely positive, averaging 11,000 per month. So also on Wednesday, we had the ISM manufacturing number. 50, remember, is the demarcation line between expansion and contraction. The expectation was we'd come in at 49, and we did, 49.1. Wednesday, jobless claims. No data to report. The expectation was 223,000 new claims. And then on Friday, we were to have all the payroll numbers, non-farm payroll, private payroll, unemployment rate, average hourly earnings, and ISM services, and we got nothing for all of those. So nothing to report there. So the GDP estimate, third quarter ended last week, September 30th, and so we had a very strong second quarter. First quarter very weak. First and second quarter very much affected by the tariff issues that were in late March, early April. So this one, this quarter, the third quarter, should not be that dramatically impacted by tariffs. And the expectation by the Atlanta Federal Reserve is that the economy grew at a very rapid pace. We'll see. Well above what the mainstream economists, thanks to the Atlanta Federal Reserve, believe that we grew at 3.8% in the third quarter, which would be remarkable, again, given the fact that we see labor numbers both from the BLS while they were reporting and ADP suggesting a clear slowdown in labor. So inflation expectations, that has been really stable, spiked up to sort of 2.4% just a few weeks ago, but back down again. It's at 2.33%. That's the implied expectation for inflation expectations annually for the next 10 years. In terms of the next Fed meeting that happens at the end of this month, and the expectation is 95% probability built into the Fed funds future market, we'll get one cut, exactly one cut, 25 basis points by the end of the year. almost it's 99% expectation that we'll get 2 rate cuts, but no more. So priced in for the rest of the year, 2 rate cuts. So how did the markets respond last week, in particular with a vacuum in terms of government economic data, government shutdown? Answer is really well. So it was an impressive week. S&P 500 up 1.1%. And now on a year-to-date basis, despite all the geopolitical, political, tariff issues during this year, S&P 500 year-to-date up 15.3%. Also last week, international markets up, and even more so than the S&P 500. The developed market ex-US index up 2.5%, and emerging markets up really strong last week, up 3.6%. Again, we point out the fact that S&P 500 year-to-date, great year, up 15.3%, but international markets have outperformed. Again, developed markets ex-US up 24.5%, emerging markets up 27.8%. Fixed income last week, another good week. So we had the 2-year yield down 7 basis points, 10-year down 5. So on a year-to-date basis, the Bloomberg U.S. Aggregate Bond Index up a very strong 6.4%. So let's look forward to economic activity this week. Oh, we can't. There's no government data being released. So initial jobless claims on Thursday, the expectation is still 229,000 new claims. We may or may not get them given the government shutdown. One that we do expect to get those on Friday, the Michigan Consumer Sentiment. This doesn't drive the market so much anymore. Nonetheless, the consensus is it should come in at 55 for the month of October. For the month of September, it was at 55.1, so virtually no change. So that's it for our weekly recap. We thank you so much for your attendance, and we'll look forward to seeing you next week. Thank you.